I really apologize for the abrupt end of our last lecture. Due to some technical glitches, the lecture was stopped in between. So again, I'll start from the topic which I left. So we were discussing the types of market, and we discussed there can be two types of market. The first one is the spot market, and the second one is the forward market. And we discussed on the spot market, on the spot transaction will be done, just like Salman Khan. Whatever the thing is, suppose you want to purchase the shares. If A wants to purchase the shares, so A will get the shares. It's not, no commitment will be made of the future date. It's not like there will be contract between A and B that A wants to buy the shares or A want to sell the shares on some future date. So no such contract will be signed in case of spot market. But in case of forward market or a derivative market, a contract will be signed between two different entities, that I will buy or I will sell this much amount of shares at this price on some future date. So forward market in India, the maximum time frame allowed by SEBI, it is 3 months. So within 3 months, it can be anything. It can be 1 month, it can be 2 months, it can be anything. So under this forward market, the first one is the futures. So let's discuss what is futures is. So in case of futures, there will be a contract that will be signed between, suppose, these two entities A and B. And what A is saying, I will buy 100 shares at 500 price after 1 month. Now suppose after 1 month the price of the share becomes 550, possible. The price can also become 450 or 400, it is also possible. So what is going to happen is, suppose the price becomes 550, but this entity A will purchase this 550 is, we can say, the market price, but the cost price for A will be 500 only, because B said that A will purchase 100 shares at the price of 500 rupees. So that will be the profit of A. A will gain in this case. How A will gain? Because the market price is 550, but A will be able to purchase the same shares at the price of 500 rupees, because that was the contract. Suppose ICICI is signing a contract with B. So what I will say, I will buy 500 shares of Infosys at the price of 1000 rupees. So whatever will be the price of Infosys after 1 month, ICICI has to sell me the shares at the price of 1000 only. So if the price increases in case of futures, that will be the profit of the investor, and if the price decreases, that will be the loss of the investor. And these are the financial institutions. These are the merchant banks, ICICI Direct, then Sher Khan, all these are the merchant banks. Then the next will be, suppose the price of this share becomes 450. So A will be forced to purchase at 500, but the problem is it is instant. On the expiry of this future, the futures and options and all, the expiry date is the last Thursday of the month. So on that very last Thursday of the month, you have to execute this particular commitment. It means A will be forced to purchase at 450, that is the prevalent market price, and instantly A has to sell at 500. A will be forced to purchase at 500, because that is what the commitment is, and because the prevalent price is 450, so instantly A has to sell at 450 only. Now the thing is something that is known as the margin money. In case of futures, you are doing a trading of 100 shares that cost 500 rupees each. It means 50,000 rupees. 50,000 rupees, ideally A should pay to B and B should do the transaction. But because it is of a future date, so exactly the amount that B requires is not 50,000, but certain percentage of this 50,000. That depends, varies, because this service is being provided by B, so it varies. So suppose the margin money is 5,000. So just by paying only 5,000 rupees, you are doing a transaction of roughly 50,000 rupees. And this is the facility which is being provided by B. So suppose the price becomes of this share, the price becomes 450. So when the price becomes 450, your loss is 5,000. Suppose within very next day, this contract will be expired after 1 month, but suppose just within 15 days, the price of this share becomes 450. So the loss of A is now 5,000 rupees. This is a notional loss because A has not executed this particular contract. So this is a notional loss. Notional loss means if today A will sell, this will be the loss, but A has not sold it. This is just a notional loss. So the loss of A now is 5,000 rupees, but A has deposited only 5,000 rupees with B. Now B will execute this particular commitment, whatever the contract was signed. So if your loss becomes more than or equal to the margin money, B will execute this particular contract before the expiry. It means even before the expiry of the 1 month. The reason is, now suppose your loss becomes, the price becomes 445. So your loss is going to become 5,500. So who is going to bear this extra 500 rupees? B will not bear this 500 rupees, because now suppose A will sell it. On the 16th day, this was the 15th day, on the 16th day the price becomes 450. Who is going to bear this 500 rupees? B will say, I am not going to bear it. So on the very 15th day, when the price touches this 450, B is going to execute this particular contract. So the thing is, when loss becomes more than the margin money, it is the contract will be executed. But on the other hand, suppose your gain becomes 5,000 rupees and the price becomes 550. So you are getting extra 5,000 rupees, not on 50,000 rupees. This 5,000 rupees gain is not on 50,000 rupees. It is only on the 5,000 rupees which A paid to, because actually A paid only 5,000 rupees for a transaction which worth rupees 50,000 rupees. But from the pockets of A paid only 5,000 rupees. So A is getting extra 5,000 on 5,000. It means 100% profit A is getting. And in this case, A is getting a loss of 5,000 over 5,000. It means 100% loss. So that is why we say futures is highly risky, because you are getting this money on margin money. The profit and loss is being calculated on the margin money. So more risk, more returns. It is highly risky thing. That is why it is giving you more return. Just like 100% within 1 month. No financial instrument can give you 100% return, or we can say no legal financial instrument can give you 100% return within 1 month. So this is what we have futures. In case of futures, if the price increases, if the share price of the particular company increases, that is gain, and if the share price decreases, that is the loss. So this is more than enough from exam perspective. And then we have options. In case of options, so here it is mandatory to sell after 1 month or the last Thursday of this month. A cannot refuse. So A will be forced to purchase at 500 rupees, and whatever will be the prevalent market price, at that prevalent market price A will be forced to sell it. Now the thing is, in case of options, you have the options that I will buy 100 shares at 500 price after 1 month if I want to. It means in case of options, it is less risky. Why it is less risky? Because in this case, suppose the price of the shares becomes 450 and A has already paid 5,000 rupees, but A was supposed to pay full 500 into 100, it means 5,000 rupees. So A is having the option to pay the remaining 45,000 rupees, because A already paid. So A will pay remaining 45,000 rupees to B and convert these shares. Of course, A will purchase only, and in the market it is 450, but A is having the option to purchase the shares in 50,000 rupees is the cost price, but in market they are available at 450. It means the market price is 45,000 rupees. So again there is a notional loss of 5,000, but A can convert these shares into your portfolio. Converting the shares into your portfolio means now I own these shares, and it means in future I can sell it. Now I own it, I am the owner of these shares, so maybe in future I can sell it if I am thinking that the price of these shares is going to increase. At present the price is 450, but suppose I know, and this is the month of suppose June, and suppose I know that after monsoon, in the month of October, November or so, the price of this share is going to become 600, 650, 700, 550, whatever price I speculate. So rather than selling at present at the loss of 5,000 rupees, I will convert these shares into my portfolio. It means I will become the owner of these shares, and then maybe after 3, 4, 5 months, when the share price will increase, my notional loss is going to decrease, and maybe after 4 months, 5 months, 1 year, 5 year, whatever the time frame allows, so maybe I will sell these shares on some future date as per my wish, because now I own the shares, so it means there is no contract. So in case of options, the investor has the option to sell it or not to sell it on the expiry of this particular contract. So after 1 month, A is having the option to pay the remaining 45,000 rupees to B, to convert these shares into your portfolio, become the owner of these shares, and maybe in some future date, if you are speculating that the prices will go up on that particular date, you can sell it. Now it is not mandatory. A can sell it on the on this date only, and A can take a loss of 5,000 rupees. It means A is having the options either to take the loss or to convert the shares into the portfolio. So in case of options, we have put option, we have call options. It means to buy the shares or to sell the shares. Then we have the short selling. Short selling is just the opposite of futures. In case of short selling, it means in case of futures we discussed if the price increases, that will be the gain. In case of short selling, it is just opposite. In case of short selling, I don't have the shares. But still I sold the shares by signing a contract that within 3 months, whatever the commitment date, but the maximum time frame is 3 months. Within 3 months, I will purchase the share. That is known as short selling or shorting. It means I don't own any shares of this company, but still I sold it with a commitment or with a contract that within 3 months I am going to buy back these shares. So that is known as short selling. It is like I will buy 100 shares at the after 2 months because I have already sold it. So this buying price is not fixed. My cost price, the price at which I have sold it, is suppose 500 rupees. I sold it in 500 rupees today, and after this 2 months, if suppose the price becomes 550, so this 550 will be my cost price, because now I have to purchase. So the price at which I will purchase is 550, and the price at which I have already sold these shares is 500. So cost price is more and selling price is less. It means I am in loss. Suppose after 2 months or whatever the time frame is, and it is executed on the last Thursday, same like futures. So suppose the price becomes 450 after 2 months. So the price at which I am going to purchase it, the cost price will be 450, and the price at which I have already sold is 500. So cost price is less, selling price is more. It means I will be in profit, or we can say gain. So shorting or short selling is just the opposite of futures. In case of futures, you are signing a contract that in future I am going to purchase at this particular date. In case of short selling, you have already sold at some price, whatever the prevalent price during that time. Maybe suppose this is the month of June. So in the month of April, you have already sold the shares. So in April, you sold by a promise that by the month of June, I am going to purchase it. So this is what we have, short selling. Then we have intraday and intraday trading. Intraday means within the day. So in case of short selling also you have intraday, and intraday means maybe the very next day. Then we have few definitions which are related to the share market. So first definition is bull. Bull means it is a person or an investor who thinks that the shares or the share market is going to go up, and when you are speculating the share prices are going to go up, then you will purchase in bulk so that in future you can sell it. So bull is a person who purchases in bulk, and bullish market. So bullish is a condition in which there is a lot of buying in the share market. Then we have bear. Bear is a person who thinks the share prices are going to go down. So bear is a person who sells in bulk, and bearish market, it means the selling market. Then we have stag. So we discussed primary market. In that primary market we discussed IPO and FPO. Stag is an individual who invests predominantly only in the primary market. So such type of investor which invest majority of the times in primary market is known as stag. Then we have arbitrage. So arbitrage is, suppose NSE is there and Bombay Stock Exchange, and the share price of Infosys is 550. For example, this is just an example. And in BSE also, is it possible that the share price of Infosys is 550 in NSE and in BSE it is roughly 1000 rupees? Have you come across this such scenario? No. The reason is it can usually 545, 547, 548 or 550 plus minus 1-2 rupees. We can say 552. So arbitrage means, arbitrage is an institution which is allowed to purchase from the cheaper market and sell in the relatively costly market. It means it is available, the option is available to this person arbitrage or the institution. To individuals it is not allowed. Arbitrage means to purchase from the cheaper market and sell in the relatively dearer market or the costly market. So when they will purchase from this market, so the demand of shares is going to increase. So that is going to increase the price to 551, and when more shares will be purchased, they want to sell at relatively high price. So more suppliers will be there, that is going to decrease the price, so it will be 551. So ultimately the price will almost be same, plus some commission will be charged from NSE as well as BSE. So this arbitrage is the reason that the prices of the shares of the companies is almost same in all these stock exchanges. So arbitrage is not allowed to the retail investors. Me and you, we cannot do the arbitrage, but to the big financial institutions it is allowed. Then we have ETF. ETF is the exchange traded fund. Exchange traded fund means rather than speculating, in case of share market is nothing but the speculation. So in case of speculating the shares of individual companies, you are speculating the full share index. It means you are speculating whether the Sensex is going to go up or it is going to come down. Similarly, whether the Nifty is going to go up or it is going to come down. So you are speculating on the full Nifty, on the full Sensex. The reason is because Sensex consists of 30 companies and it diversifies your risk. Suppose the automobile sector is going down, pharmaceutical sector is going down, but the construction is going up, the hotel sector is going up, agriculture sector is going up, the cotton industries is going up, the sugar industry is going up. So it means overall your risk has been diversified. Had you invested only in the automobile sector, which has gone down, so that was your loss. So to avoid this loss, you can speculate on the full Sensex. or you can speculate on the full Nifty. So rather than speculating the individual share prices, you are speculating the indices of these stock exchanges, that is known as exchange traded fund. A derived concept of this ETF is, what you can do is you can group out few companies and now you can sell these companies, just like we discussed mortgage backed security. You are creating a derivative security on the basis of some assets. Similarly, you are creating a new type of ETF on the basis of these different companies. Just like last year the government came up with a new ETF. The price of that ETF was based on the price of 15 PSUs working in different sectors. So on different sectors, if you will invest, what is going to happen is that is going to diversify your risk, and when your risk will be diversified, there are less chances of the loss. That is what the concept of the hedge funds. What is hedge funds? Hedge funds is nothing but it diversifies your risk. So hedge fund holder, whoever manages the hedge fund, will invest in maybe government bonds. So of course the return is less, but the risk is less. So suppose this hedge fund holder is having 100 rupees. So this hedge fund manager maybe invested 20 rupees in bond. Then they will invest in gold. Then they will invest in the share market. They will also invest in the insurance, invest in the provident fund, invest in the foreign exchange rate. They will speculate whether the exchange rate is going to go up or going to go down. They will invest in the land. Maybe they will invest in some other country, maybe in USA bond, USA government bond. So through this, they are diversifying your risk. 10 rupees they invested in gold, 5 rupees insurance, 7 rupees here, 10 rupees here. It means hedge fund means it diversifies your risk. Because after 2008 recession, it came that share market is also not risk prone. So you have to diversify your investment, and that is what the major concept of the ETF. Under ETF, to diversify your risk, rather than speculating the prices of shares of individual companies, you are speculating the price of the full stock exchange. So this is what we have, the ETF. Then we have the buyback of shares. So it is possible, suppose this company diluted 20% of the shares, and 20% of the shares, which is roughly equal to 200 rupees. 200 shares. Now this company wants to buy back these shares. And why this company wants to buy back these shares? There can be multiple reasons. Because we discussed what is the relevance of 75%, more than 75% ownership. So suppose this is 30%. Now the company wants to buy back 5% of these shares. And why this company will want to buy back this? Because this company wants to make some basic changes in the constitution. So to make these changes, this company needs more than 75% on the ownership. So this company wants to buy back some shares, or maybe the company wants to buy back full 30% of the shares. So what will be the impact of this buyback of shares on this market? We have something that is known as dividend. Dividend of, suppose this is 1000 rupees. And this 30% of this share which has been diluted, it equals to 300 shares. So this 1000 rupees will be distributed among these 300 shareholders. But suppose this company has taken back 5% of the shares. So now it is 25%, and now the shares will be 250. So now this 1000 rupees will be distributed among these 250 shares. Earlier this 1000 rupee was being distributed in this 300 shares. So whenever there will be buyback of shares, the value of the dividend or per share dividend increases, because earlier the dividend value was 1000, which was being distributed among these 300 shares. Now the company has buyback few shares, so now the available shares in the market is 250. So now 1000 will be distributed among these 250 shareholders. So whenever there is a buyback of shares, the dividend per share increases. So this can be misused. Suppose the company buy back 5% of the shares and did some lot of changes and again came back. So to avoid such a situation, the SEBI said whenever there will be buyback of the shares, For example, this company buy back for 30%. So company is not allowed to come up with the IPO or FPO for 6 months. So all these are some constraints which are being levied by the SEBI. Then in case of buyback of shares, we have one more concept that is known as safety net. Safety net is very similar to buyback of shares, but it is being implemented at the time of IPO. So whenever the company comes up, or when the company for the first time wants to dilute and there is some under subscription, we discuss under subscription. It means the company wants to sell 1000 shares, but company has got the bid only of 500 shares. So now the company itself wants to buy the remaining 500 shares when this company will be listed. So when IPO will be launched on the listing date, this company will buy back 500 shares, 500 remaining shares. This is known as safety net. How it is different? Safety net only comes into picture whenever there is an IPO, and buyback of share is a general concept. Then we have green shoe option. The green shoe option is, suppose there is some oversubscription and the company wants to dilute 20% of the shares. So when the company wants to dilute 20% of the shares and there is oversubscription of 2.5 times, it means what? It means whatever the shares this company wants to dilute, suppose 1000 shares this company wants to dilute, but the bid which is being this investor, it is 2500 bids. So this oversubscription is of 2.5 times. So this oversubscription will mean different types of investor. For example, RII oversubscription is 2.5 times. Then there can be the QIB, it can be suppose 10 times, and NII maybe it is just 4 times. And then there will be average, because out of this 1000 shares, 35% will be reserved for RII, 50% for QIB, and remaining 15% for NII. So within this types of investors also there can be different types of oversubscription, and finally there is an oversubscription of 2.5 times. So whenever there is oversubscription, the company can say, when I am going to dilute the ownership, if the oversubscription is more, I will sell 15% extra 15% I will sell in the market. So that is known as the green shoe option. While coming up with IPO only, this company said if there will be oversubscription, I will again dilute suppose extra 15%. So whenever the company uses this green shoe option, the chances of getting the shares increases. In this case, only 1 out of 2.5 investor will get the shares, because the oversubscription is 2.5 times. So if the company will dilute few more shares, it means if it becomes 1250, extra diluted 15% will make the total number of shares 1250. So now rather than 1 out of 2.5, 1 out of 2 will get the shares. So this is known as green shoe option. When the company is coming up or is listing with the share market, at that time only the company is saying if there will be oversubscription, I will dilute some extra percentage of the ownership. If that option is available, that is known as the green shoe option. Then we have differential pricing. Differential pricing is, suppose the company said that my band given by the company is 200 to 220. You have to bid between 200 to 220, and whatever will be the cutoff means the final price at which the shares will be listed. Suppose the shares are listed at, from this, the shares are listed at 214 rupees. So if the shares are listed at 214 rupees, the company has said I will give 10% discount to the retail individual investors. So this RII will not get in 214, although RII gave a bid of 214, but RII will get at 10% discount of this 214. It means RIA has to pay just 190 something, whatever that 193 rupees. So RIA will pay 193 rupees and will get the share, and the market price of the share is 214. So that is known as the differential pricing. So to some of these investors, the company can give some discount. So the maximum allowed is 10% to RII. As per SEBI, you can give at max 10% discount to the RII. This is known as the differential pricing. Then we have the margin. Just like we have futures, just like we have options in which you have to pay margin money or the compensation money, and the transaction will take place in the future. Suppose today you want to do some transaction. In spot market also we have this type of flexibility, that is known as margin. In case of margin, today you want to do the transaction, that is fixed, in which you are saying I am buying again 100 shares at the rate of rupees 500. It means you should pay 50,000 rupees to buy these shares. But suppose you are just an intraday trader, you want to sell today only. So rather than paying this full 50,000, this service provider or the merchant bank, for example we have ICICI Direct. So ICICI Direct will say, you just pay me certain percentage of this 50,000. It means just pay me 10,000 rupees, 10% of this, and then you can purchase the shares of 50,000 worth. The only condition is you have to sell it today, or pay me the remaining 40,000 rupees and convert this into the convert this thing into your portfolio. So such option which is being provided by this thing, that is known as margin. The purpose of the margin is to increase the liquidity because if an investor wants to buy this 500 shares, so this investor should have 50,000 rupees in his or her account. But suppose I don't have 50,000 rupees, I'm a very poor faculty, so I don't have 50,000 rupees, I just have 10,000 rupees. So if I have 10,000 rupees and this platform ICICI Direct is providing me a platform to purchase this shares worth rupees 50,000, maybe I will purchase it, but the only condition is I have to sell it to it. So I will speculate for just one day. So such type of facility is known as margin. Now suppose ICICI Direct is saying that you have to pay just 5,000 rupees for doing a transaction of 50,000 rupees, but you have to sell it today. This is known as margin plus. This such options like margin, margin plus, what they will do is they will increase the artificial demand of the shares, which artificially increases the price of these particular shares. This exactly happened in case of China. China share market crisis. The reason of that China share market crisis was this margin and margin plus. Suppose SEBI today is allowing, maybe from last 5 years this margin and margin plus is allowed in Indian market, and suddenly on one day this SEBI said it is not allowed. So what is going to happen? The confidence of the investor in the share market is going to decrease. Now unless and until I have 50,000 rupees, I cannot do this transaction because this is not allowed and this is not allowed. So it means the demand of these shares, the demand of these 100 shares is going to come down, and when the demand is going to come down, the supply is going to increase and the share market will come down. That exactly happened in case of China. So the reason of China share market crisis was margin and margin plus options suddenly stopped by their regulator. Then we have the face value. Now this is again a very good concept. The face value is, suppose the IPO is launched or the FPO is launched and the market price of this share is 500 rupees. Now this is suppose 2014. The company performed well and all, and in 2018 the price becomes 4,000. Now when the share price increases, the liquidity of that particular share decreases. The trading, now unless and until anybody is having 4,000 rupees in his or her account, they cannot purchase even one share of this company. So the liquidity of the shares decreases. So when the liquidity decreases, the company wants to increase the liquidity. Whoever owns, suppose again Infosys is there. So now Infosys wants to increase the liquidity. So how Infosys can do is, Infosys has to split the shares. So Infosys will split whoever is having, what is market capitalization? Market capitalization is equal to number of shares multiplied by price of shares. Now what I am saying, I am splitting this one share into suppose 5 shares. So now the new price will be 800 rupees, and earlier whoever was having one share, now there will be 5 shares in his or her account. But the market capitalization, the number of shares will be increased by 5 and the price will be decreased by 5. Ultimately, the market capitalization will be same, because market capitalization is number of shares. So now you have converted one share into 5. So 1 will be replaced by 5. So number of shares will be multiplied by 5. But the price has decreased by 5. So it will be multiplied by 1 by 5. So ultimately what is going to happen? The market capitalization is going to remain same. The only thing is the company wants to increase the liquidity by splitting the shares. But how me and you will get to know that this company has splitted the shares by 1/5, 1/4, 1/3? How? That is known as face value. Whenever a new company comes up with an IPO, the face value by default is 10. And when such type of thing will happen, when the company has split one share into 5, this face value again will be divided by 5. So in 2008, the face value of this company will become 2. In 2014, the face value of this company was 10. So that is what the relevance of the face value. So that investors will get to know that there has been a split of the shares. If the face value is 2, it means it has been split by 1:5 ratio. If it had been split by 1:10 ratio, so the new face value is 1. This is what the significance of the face value. Then we have the insider trading. Insider trading means sharing the information, sharing the confidential information of the company to the outside world for some profit. If your purpose, suppose I am the member of board of director of Superprops and I came up with some information, and suppose Superprops is listed in NSE and I know some information which will help me or my relatives to decrease or to increase my profit. So for that, if I have revealed some information, some confidential information, if I will reveal for some profit gains, that is known as insider trading, which is illegal. Then we have SEBI. Just like RBI is the papa of money market, similarly SEBI is the papa of the capital market. So some factual information is there which will be provided to you in the notes. But SEBI was established in 1988. Finally, on the recommendations of the Narsimham Committee, SEBI became a statutory body. SEBI Act came in 1992. And then what are the functions of SEBI? Functions, it is the regulator of the primary and the secondary market. Then all these intermediaries, they will register, the share brokers and all, they will register with the SEBI. And then for the development, for the information of the investors, SEBI starts fee program. That is the responsibility of SEBI. So all these are the functions of the SEBI. And SEBI has done a lot of reforms in the capital market. One of the reform is DMAT. DMAT means dematerialize. It means conversion of the physical shares into the online or the computerized form or the soft copy. That is known as the DMAT. So we have NSDL, we have CDSL. So all these companies, they have created an online database of the shares. And what is the relevance of the online database of the shares is, because in case of physical share, there are chances that there will be duplication, frauds will be there, wear and tear is possible, theft can happen. So to avoid all these things, you should have a database of the shares that should be available online, which can be accessed from anywhere. Suppose today I am in Pune, so I should have access to my portfolio, how many shares I own. Suppose maybe after 1 week I will take classes in Mumbai, so at that time also I should have this access of this information. So this should be provided online. So now we have dematerialized account, that is known as DMAT account. If you want to start the share trading, what you want is a DMAT account with the service provider. Then we have the rolling settlement. The rolling settlement means the time when you have given rupees or when you have sold the share or you have purchased the shares. So the moment you have paid the price to this guy B, and suppose this is A, so the amount of time which is between this purchase of share or selling of shares and the actual price that comes into your account. Suppose you have purchased, you have sold some shares, and at what is the time that is required that money will be available in your account, that is known as the rolling settlement. So earlier it was T plus 5, now it is T plus 2. T means the transaction date. Suppose today, maybe on Monday, you have sold some shares. So T plus 2 means by Wednesday, money will be credited in your account. Similarly, suppose you have purchased some shares. So after T plus 2 on Wednesday, these shares will be credited in your portfolio. What was the time frame required? It has become T plus 2. Then we have circuit breaker, which is again a very good concept. There can be two types of circuit breaker. In electronics also we have this concept of circuit breaker. क्या होता है? It means if this is the circuit टूट गया, that is known as the circuit breaker. So what is the role, what is the significance of circuit breaker? You know, we have fuse and all in case of electricity houses. What is the role of fuse? The role of fuse is, suppose in case of some contingency, some electronic fault is there, in that case circuit will be gone to save the particular house. So same is the scenario of circuit breaker in case of share market. Suppose one company is there and somebody has speculated this company is going to file bankruptcy. Today somebody has speculated and this person is having the knowledge that this is just a rumor. The purpose of spreading this rumor is to decrease the prices of the shares, and when the prices will be decreased drastically, I'll purchase it in bulk. So in case of these companies, suppose the price of the share is 100 rupees and this rumor was spread by n number of means, and today only the price becomes 40 rupees, and tomorrow when the investor, they will get to know this rumor was false, or whatever the information was false, so that will be the loss of this innocent investor. So to save such scenario, SEBI said there is a 20% limit. It means at max in one day the share price can go to 120 rupees or it can come back to 80 rupees. Only 20% plus minus of the present share price is allowed. So that is known as the circuit breaker. Suppose every day somebody is doing this speculation. So in that you have to decrease this 20% cap. So maybe NSE said in NSE only the shares are going up and down 20%. So NSE can decrease this 20% to 10%. And again if there is lot of speculation on this 10%, then they will decrease it to 5%. So to individual companies there can be three types of circuit breaker, that is 5%, 10% and 20%, irrespective of the demand. For example, the share price today becomes 120 and there are a lot of purchasers who wants to buy at 120, but the window is shut down. Nobody can purchase above 120. That is what the circuit breaker is. This is a cap, maximum cap. The share price can anything between 80 rupees to 120 rupees in one day if the circuit breaker is a 20%. It is possible that in NSE for this company Infosys, the circuit is 10%. Right now the circuit is 10%. And in BSE, the circuit for Infosys is 5%. Because this circuit, company specific circuit breaker, is being fixed by the respective stock exchanges. But suppose the full stock exchange is also speculating. Just like in case of 2009, when UPA 2 came in the came to power, at that time the full prices of this indices, they speculated and they increased by more than 10% within just 1 hour. So it is just a speculation. A lot of things is happening over this present speculation only. So when more than 10% increase or decrease in the full indices of NSE or BSE within 1 hour, then the Papa will come into picture and SEBI will break the circuit. So it is being said that if The share, if the indices of NSE or BSE or the stock exchanges increases or decreases by more than 10% in just 1 hour, that circuit will be break. It means no transaction on that particular day. Now the NSE or BSE will open on the next working day. So this is what two types of circuit breaker. For the full indices, NSE or BSE, as well as the second type, that is known as the individual companies. So this is what we have, that we discussed related to the financial market. So from exam perspective, I think all these options are more than enough. You don't have to waste your time even to read these concepts from any other book. The notes that will be supplemented to this class discussion is more than enough for the financial market. Whatever doubts you have related to the financial market, you can anytime discuss with me over the whatever the chat communication that is being provided by the super profs. So thanks a lot.